everyone. Welcome to our Q2 Asia Trade Floor update. I'm Jingjing Huang, credit strategist. Joining us today, we have our Asia portfolio manager, Stephen Chang. Thanks for being here, Stephen.
Great to be back.
So, Stephen, our latest cyclical outlook is titled Layered Uncertainty, Conflict, Credit Stress, and AI. It talks about growth holding up, but also rising pressure beneath the surface. What are the key takeaways?
At a high level, global growth has been more resilient than expected. But underneath that headline, outcomes are starting to diverge quite sharply. A big change this quarter is geopolitics. The conflict in the Middle East raises the risk of higher energy prices, which can push inflation up while slowing growth, and not all regions are affected in the same way.
Including Asia.
Yes, Asia feels this quickly because energy exposure varies a lot across countries. At the same time, investment linked to AI and technology is still supporting parts of the region. Put together, that's widening the gap between who is coping well and who is under pressure.
And this is the K-shaped economy we discussed last time. How does it shape the policy decisions?
Policymakers have less room to maneuver than in past cycles. Budgets are much more constrained. Interest rates have little room for cuts given inflation and currency stability. And financial conditions have tightened. That means shocks can feed through more directly into growth and markets.
And for investors?
It brings the focus back to high-quality fixed income and selectivity. Yields are higher than they were a few years ago, and we expect some demand weakening ahead, which can help offset some of the inflationary pressure from higher energy prices. And with markets moving differently across countries, active position matters much more.
And how are these global forces playing out in Asia right now?
One useful lens this quarter is the oil shock. When energy prices stay high, currencies often show the pressure first, especially in economies that rely heavily on energy imports. That's where the contrast between India and China really stands out.
Tell us more about the differences.
India is more exposed in the near term. Higher oil prices weigh on growth and inflation, and that can put pressure on the currency. Policymakers have tools to manage this, but the rupee can be sensitive when energy prices stay elevated. China, by comparison, is better positioned. It has more buffers, and high energy prices tend to pass through less to consumer inflation. As a result, its currency and broader macro picture are generally more stable than many Asian peers in this kind of environment.
What about looking beyond India and China?
Countries with stronger buffers or more insulation from energy prices tend to cope better. Separately, economies linked to technology and electronic cycles still see support. But when buffers are thinner, the trade-off becomes harder, and that's where markets are more vulnerable. Overall, Asia is becoming much more uneven, rather than moving as a single block.
Let's end with China. The 2 sessions has just concluded, and China is entering its 15th five-year plan. What matters most for investors?
The new 5-year plan reinforces China's longer-term focus on productivity, technology, and upgrading its industrial base. That helps explain why exports and industrial activities remain important anchors. There's also policy intention to increase the consumption share of growth and lift household income. The key question is whether the measures being rolled out can deliver sustainable impact.
How does the current oil backdrop affect that picture?
Higher energy prices can lift costs for producers, which may help turn China's producer price index positive and reduce some of the disinflationary spillovers to the rest of the world. We expect consumer inflation, however, to remain benign due to other domestic factors. Fiscal policy is likely to do more of the heavy lifting, while monetary policy stays on the dovish side, relying more on targeted lending programs rather than significant rate changes.
Thank you, Stephen. So to wrap up, global growth has been resilient, but differences across countries are widening. In Asia, higher energy prices are creating clear winners and losers, and markets are responding accordingly. In China, policy continuity and the new 5-year plan reinforce the focus on stability and longer-term growth. For more details, please read our latest cyclical outlook. Stephen, thanks again. And thank you all for watching.
Thanks, Jingjing. And thanks everyone for joining us.